So investment banks aren't really banks in the way that we think about your traditional bank. I mean, they're a totally different type of bank that helps large and small businesses and governments instead of your average person. Organizations, they really turn to investment banks because they want something. In this case, you think about the need to grow, so they want to access capital or money to be able to do this. And when you're running a business, you could always access capital with a loan by selling equity or some partial ownership of your company, right? So let's take a simple example of how an investment bank works. So let's picture Marissa. Marissa's just created an online concierge service, and this leverages predictive analytics and AI to make personal recommendations for clients. So after 3 years of operations, Marissa has grown her company, and now she wants to expand it even more. So she decides to raise capital by selling almost half of her company to the public. And in this case, the public really just means outside investors. To do this, Marissa approaches an investment bank, which after doing a really comprehensive and thorough analysis, and really what they want to try and see is an assessment of this business. The first step in the process belongs to the division within the investment bank known as Equity Capital Markets, to help prepare Marissa's company for the sale of some of her equity. First thing, they create a prospectus, which basically is a document that shares some critical information on what an investor would need to know about Marissa's company. This will include past, present success, future potential, management experience, all that good, juicy stuff. And really, this is a required and a regulated document. So once that's completed and approved, the investment bank's institutional sales team takes the prospectus on the road. And what they're trying to do is they're trying to build interest in Marissa's company. Their goal is to be sure that investors are ready to line up for this first block of stock or shares in Marissa's company when they become available. This is what we all know as the IPO. This is the big initial public offering, in case you never knew what that was. As part of the process, the investment bank also determines the most strategic exchange to list Marissa's company on. Really, the goal here is so that shares can be bought and sold easily and fairly by investors. Lastly, the investment bank's equity capital markets team will use analytics and their own expertise to set the right initial price for these shares. So this has to be the price that will generate the most money for Marissa while not being too expensive that no one's going to want to buy them. And there's a real good sweet spot there. So the big day's here, IPO day. Everyone's excited. Marissa's company goes public, maybe even rings the bell. Marissa gets her money so she can continue to invest in technology and other things that are really going to help her grow and scale her business. And while Marissa scales and grows, the initial buyers, or shareholders if you would, they are the ones that want to make some money as well. I mean, they're not in this just for charity, right? So what they do is they can either start collecting dividends if this is offered to them, or regular payments that Marissa's company may offer out of its profits or reserves. Or of course, and this is maybe more the traditional way that we think about it, they're going to look to trade some of these shares to other investors at a higher price than they paid if they're smart. So one really important part I want to make sure that we cover in this example is let's pretend Marissa's company has done so well that they decide to start buying other concierge companies. So to help her, Marissa works with the investment banking division in this case, right? These are the ones who are the deal makers. They're on the M&A side, mergers and acquisitions. And they're going to help to merge companies together or help companies buy one another. So obviously, this whole example has been overly simple. I get it. It really doesn't cover the full breadth of what investment banks do, but I think it's a really good start to try to learn what it is that investment banking is all about. I am a little biased though.